getting up and giving a somewhat bearish forecast of the future of the industry that you're in can be stupid, can be considered a bad decision. I was hopeful that my talk would reach people who share my opinions and stimulate some discussions about how we could be more proactive about this. My goal in giving the talk was to really emphasize where I think Bitcoin needs to go, to attempt to try to shift the political consensus using data. The risk in the talk would be that I come across as a whiny miner. I think, no matter what, there are some people in our industry who would see it that way.
You ever get into your buddy's car and think, dude, how do you live like this? There's half-eaten Taco Bell on the console, a pile of garbage and fast food cups and bags, rumbling in the trunk. You look behind you under your seat and you're pretty sure you saw something move, but you don't know what. Well, how do you think your Bitcoin miner feels if you're not keeping on top of your filtration game? Y'all need to get on Colorado Air Filters. Colorado Air Filters is a major supplier of air filtration systems for Bitcoin mining sites. And they're currently running a summer sale on their inventory, so now is the time to act. Whether you need HEPA filters, new shipments or installations for your containers or your large-scale mining facilities, retrofitted buildings, Colorado Air Filters has it all. And units are ready to sell now. Contact sales at coloradoairfilter.com and use the code MININGPOD to claim 15% off today. Again, that is sales at coloradoairfilter.com with code MININGPOD.
Hey, Will here with Blockspace Media. Did you know that we have individual feeds for all our shows? If you're watching the Mining Pod, Bitcoin Season 2, or the Court Show, be sure to check out the individual feeds. You can find them on your podcast player of choice, whether that be Spotify, Apple, YouTube, etc. Just type in Blockspace Media and you'll find all our shows pop up, or just type in the individual show name like the Mining Pod or Bitcoin Season 2. Be sure to hit that subscribe and give us a 5-star rating so we can continue to bring you the best content in Bitcoin. Hey, welcome back to the Mining Pod. Today we have James McAvity.
You got it right.
He is most well known for Cormint, being CEO of the West Texas Bitcoin miner. Also well known for his hair, Bitcoin Jesus around town for those who don't know him.
I hope I'm having a good hair day.
So, James, if you will, you gave a really awesome talk at the Bitcoin conference. Not a lot of applause afterwards because I think there was a lot of thoughts spinning through people's heads. Basically, the idea was, hey, we're kind of screwed with Bitcoin mining unless things change. Yet you are the CEO of a Bitcoin mining company. Tell us about the talk. Tell us about what made you want to get in front of stage, in front of 500. Maybe that was a pretty packed crowd for talks. What made you want to get up there and say that?
Oof. Yeah, it was a difficult decision, and a lot of back and forth went into making the decision to have that conversation, because getting up and giving a somewhat bearish forecast of the future of the industry that you're in can be stupid, can be considered a bad decision. And I was hopeful that my talk would reach people who share my opinions and stimulate some discussions about how we could be more proactive about this. I think that if you have that opinion and you don't do anything about it, it could be considered deceptive. And also, I've been in this industry for 12 years. Yeah, so when you were probably just entering puberty,
yeah,
I was slanging coins.
No, for the record, I'm 29, but it is crazy how the mental history for some people like yourself who've been around the block a little bit longer, it's changed a lot in 10 years.
We all have brain damage. Yeah. If you've been in the cryptocurrency industry, whether Bitcoin or other, you've some form of brain damage. Yes. And it's hard to be around for a decade. It does seem to be that people who've been around for the longest time tend to be a bit more jaded. And it's because you live through seeing this really divine technology with this very unique story, ancestry, call it, with the Satoshi. I call it divine because, Satoshi's disappearance has a divine quality to it, where you come in very idealistic and all you see is potential. And then you get through a few cycles and you see a lot of opportunistic behavior. People come in and can make a fortune. It's telling one story and they can quickly turn. I think there's some great examples. Richard Hart maybe was my favorite example, who's an ideological, somewhat of a pure soul, and they just turn into like a hardcore, opportunistic.
Is he still on the run? I've not caught up with that one.
I'm not sure. I don't follow along with it very closely, but yeah, it's tough to not get jaded after a while. I think there's people in the Ethereum community who feel the same way. There's people in every community who've been around all of the various actors who get a little jaded. And Bitcoin is obviously the most pure technology in the entire industry. I think I would feel deceptive if I didn't really tell the truth, and I don't want to.
Yeah.
I can see, and I have some numbers to back this up. One number that I'm starting to drill down on is the dollars per megawatt hour cost of confirming a transaction right now if there were no subsidy.
Yeah.
And I think if you can just sort of distill these numbers down to what is the actual dollar value we're talking about here, it makes it a lot clearer what's going to happen 20 years from now.
Yeah.
And it's 20 years away. Nobody really wants to talk about it. Bitcoin could go to $5 million over the next 20 years, and then it would be very hard to reason about what mining incentives are going to look like and what transaction fees will be.
Yeah.
But one thing is for sure is that there is a lot of financial activity happening that's connected to Bitcoin. The Lightning Network scales a single UTXO 250 times over, doesn't pass through revenues to miners. Don't love that, but I also understand the reasoning for Lightning being mainly for smaller transactions where it wouldn't make sense to touch the main chain. The CME generates a ton of fees on their derivatives products. The ETFs generate a ton of fees on their custody products. Deribit, same thing on their derivatives products. All of the exchanges with their products, and then the borrowing and lending industry, Bitcoin-backed loans, Bitcoin loans themselves. There's tons of fees being generated on Bitcoin. Not a lot of that is passing through to the miners, and that's really customers of those platforms expressing a choice. I want to use this centralized platform to accomplish XYZ service. And that's also, at least in some way, connected to Bitcoin's lack of functionality in those areas. And so my goal in giving the talk was to really emphasize where I think Bitcoin needs to go, to attempt to try to shift the political consensus using data. And the risk in the talk would be that I come across as a whiny miner. I think, no matter what, there are some people in our industry who would see it that way. But
great overview. I'll give some more context setback as well. The idea that we can't just exist on transaction fees in the future. After enough subsequent halvings, the subsidy for Bitcoin goes away. These Bitcoin miners, these huge conglomerations, we have getting close to 40% of network hash rates from US miners. Is it closer to 30 or 40?
I think it's about 40.
From 40. It's growing year over year considerably. These are companies with multi-billion-dollar market caps. And what happens to those companies is one question. The shareholders of those companies, as the subsidy declines and the value of what they're mining goes down, we need transaction fees, obviously, to boost the value of those companies. But then the larger question, of course, is like the network itself. Like what happens to the Bitcoin network stability if we don't have miners to step around and like pass transactions back and forth? And we need fees. Satoshi, as you say in your conversation or your talk at the conference, he was predicting that we would move over to a lot of fees or 0%. And we're at 2% basically. Why do you think we landed at like this 2% mark? Do you think that actually makes sense? Do you think Satoshi was just like, he was famously wrong on multiple things. So I'm wondering if like this is something he just is turning out to be famously wrong on, or it's just trending up slowly.
Well, for starters, I think trying to interpret Satoshi's intention is maybe not necessarily a productive use of time.
Yeah.
Obviously, Satoshi, as I said before, has a divine type of presence around the protocol, and people do interpret the things that he said almost like they're gospels. The Bitcoin Talk forum posts from Satoshi are treated like biblical verses in a lot of ways. And really, the point of me mentioning what Satoshi said in my talk was to point out that if Satoshi were around today, they might look at the protocol and say, we should have made some design choices to attempt to generate more transaction fees here at this point with this level of adoption and this number of people holding and using Bitcoin. The amount of on-chain activity seems low, and this doesn't look like a good situation. You know, if Satoshi had the liberty to make some design choices about Bitcoin as they did in those early days, and they were presented with the state of affairs today, how might they think about changing something like the block size or the programmability of Bitcoin, the development surface area, to enable more programmable, permissionless surface area for people to build financial applications that could pass through to miners? And there are lots of really smart people building interesting things that could solve these problems. I think zero knowledge proofs that utilize all the Bitcoin block space somewhat regularly to checkpoint what's happening on a second layer. It could create this huge demand for block space.
Yeah.
And it could be somewhat subsidized by the fact that there's a whole layer 2 token out there. But it remains to be seen how those protocols actually get designed and how the sequencing of those protocols in terms of what happens on the layer 2, how that passes through to the layer 1. You have concepts like MEV that need to be discussed, and you can look to other blockchains and see how they have, once you have programmability and execution existing on a layer 1, and people can actually order transactions that have more financial value than the transaction fees themselves, you need to start thinking about, okay, how does that impact the broader economics and incentives of the system? So I did an appeal to Satoshi mainly to point out where we are is inconsistent with what Satoshi forecasted, and that if we were to fast forward this current state today, 20 years out in the future, then the only way that mining revenue would have an adequacy level to incentivize continued capex into mining would be if some cohort of users was willing to pay extremely high fees, or we had this very volatile difficulty adjustment cycle. There's all kinds of very interesting dynamics in terms of the intersection between Bitcoin, block times, power markets, and how that might work in this future state. I just think what's clear to me is Bitcoin's going to be much different 20 years from now. And my view is that if things don't change, it will be somewhat weaker and easier to attack. So that's what I want to avoid. And a lot of people did come up to me after the talk and say, I agreed with you. I appreciated you saying that. This is an interesting talk. More people need to be discussing this. And I'm sure a lot of people watched it and said, this guy's a fucking idiot.
Yeah. Tough.
Or said, hey, if, like Nick Hansen said, hey, if you want to watch Jamie shill Ethereum for 30 minutes, watch this talk.
You did. Okay. I want to keep with this line of logic, though. Maybe go to one in specific. You brought up ETH L2s in the talk. You brought up Solana. You brought up DeFi. And I think for a lot of people in Bitcoin universe, like they're rolling their eyes, they don't care, whatever. Or maybe they have like some bag and they're just kind of writing it. From like a technical perspective, and I think a decent amount of our audience will know this, and then you yourself, like there's a lot of problems with those other roadmaps. So Solana has been like, hey, we'd shove everything into the L1. They have their whole like catchphrase thing is like reduce latency, increase bandwidth, I think is like their phrase. And then for ETH L2s, we've seen a complete fragmentation where the ETH L1 is like not getting any transaction fees on top of it. Everything's going to an L2. Then we have all these L2 tokens competing against each other. Some MEV issues that seem to have been resolved more recently on between the L1 and L2, but then we have the L2 MEV. Basically, we get to a point where there's more problems than solutions. So for the Bitcoin core ecosystem and Bitcoiners in general, they don't want to deal with this. So how do you get them to be on board with it? Because I see that there's the fee issue there, but how do you get them to look at the hot mess that is other altcoins trying to scale things and get them to think that could be a future solution?
That's a great question. I think that hot mess is probably a subjective assessment.
Yeah, certainly.
You know, these things have a lot of market value. They have a growing user base, and there's real economic activity happening there. you really can't just hand wave that away.
Yeah.
You can't look at on-chain data and look at the quantity of transaction fees that are being paid on, say, something like Solana and say, that's not real. You can say that's meme coin trading, and that's not a sustainable source of long-term revenue. That's a non-monetary use case. That's a valid criticism. Then I guess where you take that from there is, where are the transaction fees going to come from? And the response, sort of the steelman of the opposition, would be, don't worry about it. Number's going to go up and you don't have to worry about anything. This isn't going to be a problem for 10 years, 20 years. To me, it's just unusual that if you were in a business and you were the CEO of a company and you were trying to develop a long-term strategy and roadmap, that you wouldn't be thinking about what's going to happen 10 years from now. I think the best companies are thinking 10 years in advance or 20 years in advance, or at least 5 years in advance. And so at some point, you'll need to come to some kind of decision, some kind of conclusion about what's going to happen if transaction fees don't improve and increase materially over the next 15 years, and what can be done about that now. At what point might that be a serious enough issue that we could make a decision to attempt to push through some consensus changes? There are a lot of people who don't believe that this is going to be an issue. I think it is actually plausible that the adoption route, which seems to be where everyone's going, is just let's get as many people to adopt Bitcoin as possible. And at that point, the idea of attacking it will become taboo. Yeah. Maybe even illegal.
Yeah.
And like some of these attacks would involve derivatives or short positions in Bitcoin, or maybe a long position in another protocol, something like that. And you could make the case that that's manipulation, market manipulation, an appeal to an authority. It's just that seems to be an abandonment of the early principles, which is anti-fragility. We're not appealing to authority. Bitcoin has survived because of its resilience and anti-fragility. I don't love that we would pivot to adoption and appeal to authority to sort of maintain it. Like, I think that Bitcoin needs to continue to be very resilient. And so it benefits from being very abundant in the future, where there's a block reward subsidy that incentivizes mining. So you have 20 gigawatts of mining capacity that's pursuing block rewards. So it benefits from being abundant in the present and scarce, knowably scarce in the future via the emission schedule. But those two things, they're sort of heading in different directions. They're different roads, where it's not going to be as abundant. People have always bought it because it is scarce in the future, and 21 million coins is the hard limit. But at some point, users are going to need to voluntarily pay transaction fees to incentivize miners to continue mining blocks. And so from a dollars per megawatt hour perspective, let's talk dollars per megawatt hour. So the quantity of transaction fees right now paid is about 1/50th of the total block rewards that are earned. And so we have 20 gigawatts mining around the clock. Let's just say that's 100% of the time. 20 gigawatts is mining. You have 6 blocks an hour, 24 hours in a day. So 20 gigawatts times 144 blocks in a day. That's the gigawatt hour quantity that is being expended to attempt to mine Bitcoin. A gigawatt hour costs somewhere around $30,000, say $40,000, $50,000 would be 5 cents a kilowatt hour. So a gigawatt would be $50,000. It's a lot of electricity that's being spent right now. And if the block reward subsidy were to go away, then each one of those individual user transactions would need to effectively equate to that quantum of electricity expenditure, plus some kind of profit margin, where the miners aren't just going to mine to break even. They're going to want to expend that electricity to have a chance to earn a positive return on that investment of electricity. So you pass that electricity through a Bitcoin mining ASIC, and you're hoping that the megawatt hours that you put in and the cost of those megawatt hours yields you a greater quantity of megawatt hours that's Bitcoin denominated, which you can hedge out altogether. So if you think about it from what is the megawatt hours per transaction that it costs right now? It's expensive. And from a commodity perspective and from an electricity cost perspective, it has never made sense to me that we would expect single individual users to be willing to pay $25, $30, $40, $50 per transaction. It has always made more sense to me that we would have millions of users paying pennies for transactions. We could still offer an amazing payments experience that's very fast and costs not a lot of money. And we would win the game by volume and not by high transaction fees per transaction. That's kind of my 2 cents on it.
We are Cleanspark, America's Bitcoin miner, a publicly traded company with the largest operating hash rate, powered entirely by self-operated infrastructure across 4 states. This is our proof of work, and we are setting the standard for what's next. Learn more about the intersection of energy and Bitcoin at cleanspark.com.
I want to go to something that you talked about in your talk specifically. And thanks for breaking out the energy comparison. I actually haven't thought of it that way before. There's some things in your talk that were interesting to me, and I would almost like push back on them. When you talk about the derivatives market, in your slides, you show that Coinbase has bought Deribit, and then Kraken bought NinjaX, or I think it's NinjaX, right?
I think it's called Ninja Trader.
And then there's one other one. These derivatives exchanges are making millions of dollars a year. There's lots of fees from those things, and you sort of look at that and be like, hey, why are these centralized exchanges making so much money and Bitcoin can't make this money? I'm curious though, like when we're looking at it like from a money perspective, like the dollar doesn't do that either, right? Like the dollar doesn't get fees. Like the US dollar doesn't accrete fees to its network.
Neither does gold.
These things don't, but Bitcoin can, and Bitcoin has to at a certain point. So I'm wondering, like, is it like a spurious example to look at these derivative exchanges and use them as like, I think they'd be like more of a feature, and you get some nice network effects from it, which is great. But this is like more of a question around the nature of like, does Bitcoin fit into money if it has to have a fee associated with it, which is more akin to a centralized thing like a PayPal.
Right. And so what you're talking about there is verifiability, fungibility, and sequencing, right? Where let's just take gold, for example. The way that you verify a gold transaction is you have to have chemistry equipment to test that you're getting authentic gold, maybe melt down some of the sample. I'm not sure. Gold is not very verifiable. There is no issue with sequencing in gold because you can't double spend a physical bearer asset. If I hand you a bar of gold, there is no sequencing issue. And then you could go take it home to your local metallurgist and he'll melt it down and be like, this is real gold. Congratulations. And your transaction costs are through the roof there. So you have fungibility, verification costs, and sequencing. Fungibility is really somewhat similar to verification, where Bitcoin miners are really the source of provision of these services, where we sequence transactions. Bitcoin miners organize transactions in the correct chronological order and then present a block template that builds on top of the longest proof of work. If they've presented an inaccurate version of events, then it wouldn't be forming the longest proof of work. They would have wasted electricity attempting to find that block. So Bitcoin miners perform the service of sequencing, verification, and ensuring fungibility. And gold is a naturally occurring metal. So those issues don't exist, but you have some challenges in terms of verification. There is no challenges with sequencing because it's a physical bearer asset. PayPal maintains an internal ledger. The dollar maintains an internal ledger. Well, you have cash.
Loosely, it does.
Yeah,
yes.
Cash is a bearer asset transaction where I hand you it, and so there's no sequencing issue. Obviously, there is forgery issues with dollar bills, but it's illegal, and so counterfeiting is deterred through the the threat of law enforcement and violence. And when you are transacting with dollars inside of a digital system, you're actually relying on your bank's ledger to be sequenced properly with another bank's ledger, and bank fraud and wire fraud are the legal deterrents for you doing that. So there's really, Bitcoin is not really analogous, and Bitcoin mining is not really analogous to gold payments or dollar payments. Because it's a bearer asset in that you can bear the digital ownership of an asset, but it also requires a miner to sequence your transactions and verify those transactions as well.
Kind of a pretzel you get into, right? Because it's like it has benefits of both things and drawbacks of both things. And I think that's where I was just kind of like chewing on like what you talked about in your presentation. And I was thinking from like a dollar perspective, right? So if like we have these centralized exchanges for derivatives, and, you know, not even speaking about Bitcoin here, but like whatever you're trying to, derive, but whatever you're trying to like trade on those things, you're using dollars, right? And that dollar, they're using the fee on the net on it itself, but dollars themselves do not, operate better or have more security because there's fees on it. There's like some pretty crazy ideas out there with like monetary theory, where it's like the value of the dollar comes from the fact that people are taxed in it every year, and so there's some ideas around that I think are analogous. But
and that's the state. Think about it like this: PayPal is the sequencer in a PayPal transaction. Cash App is the sequencer in a Bitcoin transaction between two Cash App users. So Cash App will actually say, yes, Jamie can pay Will because Jamie has a Bitcoin balance at Cash App and Will has an account at Cash App. And so according to the internal ledger at Cash App, we're sequencing that we're verifying and sequencing that transaction internally. And so, the cost of that is that you're custodying your funds within Cash App. If you buy more funds, they'll earn fees off of you. Some of these platforms do charge a fee, and that is effectively the service that they provide. They provide a verification and sequencing and authentication service. You put your coins there, you transact through them. They're earning fees from that. The majority of users, I think, prefer to have that kind of relationship. This is somewhat ironic. Satoshi invented this peer-to-peer cash that is a bearer asset, and they invented it to facilitate the avoidance of all of these pitfalls of centralized monetary issuance and centralized monetary custody, financial censorship, all that stuff. And then the majority of users adopted this technology and said, I'm just going to go park it with somebody else because I really don't want to bear these assets. And so that it is somewhat ironic or counterintuitive to what Satoshi's intention was. But each one of those sequencing and verification services costs something. And in Bitcoin, the cost of that is mining incentives. And so you're right that it's an unusual thing to have to think about, where the verification costs of the system right now are borne by all users. So all users are paying for sequencing and verification through monetary issuance. So this year, 70 basis points of new Bitcoin were issued to miners. 1.4 basis points of Bitcoin were on the total supply, just to be clear, were paid to miners in transaction fees. That 70 basis points was 50 times the mining incentive that was paid to miners effectively for the services of verification and sequencing. It's what makes Bitcoin a functioning payments network. So we all paid that cost by the new issuance that was issued through software on the protocol. And the question is, how does the system work if individuals have to, instead of silently paying that cost as more units are issued, diluting the existing supply, instead it requires individual actors to pay enough transaction fees to create mining revenue adequacy for the broader mining community. And what happens if there's not a lot of revenue for miners? Those are kind of the key nuances here, because Bitcoin is not like gold. It's not like cash, and it's not like digital bank deposits or dollars in PayPal, because each one of those services does have some kind of fee that they collect on top of it all, if that makes sense.
Was the 70 bips overall supply change, and then like that's the amount that goes to miners was 70 bips?
70 bips is the percentage of 21 million Bitcoin that will be emitted by the protocol this year. So it's 3.125 Bitcoin.
Okay, subsidy.
Times, the subsidy. Exactly.
Okay. So, I mean, this is one question that's gone around Bitcoin mining circles. And for people who are not familiar, this is a good thing to know about, I think. And you're the right person to ask. It's like, have we built too much? And has the market for Bitcoin mining just grown so much because there are so many random places where there's malinvestment or bad incentives for Bitcoin, but great incentives for dollars? Take Texas, for example, right? Why is 2 to 3% of the Texas grid now Bitcoin mining? Like, because there's these things where you can make a lot of cash. Riot just made like 13.9 million, something like that last month on energy credits.
Yeah, ancillary services.
You know, that they're not even mining Bitcoin, that they're just turning off and they get those energy credits. And so that you can see it from like an Austrian economic lens or even just like a normal lens and be like, hey, this malinvestment.
The reason why Riot can do that is because they locked in their power prices ahead of time. In order to commit to ancillary services, you have to sort of own the energy.
But mining did enable them to build up a facility that size and like park those gigawatts.
True. It's true. So the question is, has too much mining infrastructure been built out? And in the event that the subsidy goes down, wouldn't that be a healthy correction where there's not 20 gigawatts that are...
Yeah, and can Bitcoin stay healthy with less mining?
Can Bitcoin stay healthy with less mining? I think that just the question there is, what is the correct number of cost to acquire the entire system?
Yeah.
That deters an actor from taking it over. I don't know if you saw on the tape this morning, but Monero had a 51% attack.
Yeah. Great time to talk about this.
And I am not totally familiar with what happened, but I think another token was launched with a merge mine on Monero's algorithm, and a single pool was able to accumulate a huge percentage of the hash rate, and then they just started 51% attacking Monero. Kind of interesting and
kind of badass, not gonna lie.
Yeah, pretty wild.
But they're not. It's like they make like 110,000 a day after, because they're paying out other miners to keep the. Did you read about it?
They're paying out in this other token that's being merge mined, and then they're using the Monero hash rate to censor. Yeah. And they're probably short Monero.
Yeah. It's fantastic.
Yeah. And so then you would say, okay, we need an appeal to authority there to say this is a market manipulation event, and we need authorities to make this a criminal offense and shut this down. The point that I would make there is, let's say that transaction fees don't go up at all, and we get to the 2036 halving. So that means the block rewards drop from 70 bips to 35 bips in 2028 to 17 bips in 2032, and then to 8 bips in 2036.
Yeah.
So you now have 8 basis points of Bitcoin's total supply that's being issued to miners to continue to perform proof of work, and maybe the total number of gigawatts that's pursuing Bitcoin. So that's dropped by about 90%. Bitcoin could go up 10x in price, and then it would be roughly the same total dollar value of block rewards that's available. So if, let's just say, let's walk with that scenario. So Bitcoin goes up 10x. So the price is $1 million a coin. Transaction fees don't go up at all. Block rewards drop by 90%. So that means that the total Bitcoin protocol is worth $20 trillion. That's great. That's higher than what
probably won't be our problem at this point, right?
It's higher than what gold is worth today. And, that would be like a globally dominant store of value, one of the most valuable assets on earth. And you have an industry that is earning 7 basis points of that $20 trillion in revenue annually. And you've got a whole bunch of competitors, a whole bunch of nation states, all kinds of people who may say, we don't really like this thing. We want this to die. We want this to go away.
Yeah.
Let's attack this thing, or let's try to build a competing currency here. To kill a $20 trillion asset, that's a big whale. You can make a lot of money shorting a $20 trillion asset. You can make a lot of money forcing $20 trillion of value out of one asset into another asset, let's say another cryptocurrency. So the point that I made in my talk was not necessarily to advocate for an attack or to insinuate that a particular actor should do this, merely just to say that this is a really competitive global money supply is a really competitive industry. You can call it that. It's 50%. All money is 50% of global GDP. It's goods and services and all money. It's half of everything. And it's not going to be easy.
Yeah.
So the greatest deterrent that we could put in place would be a mining industry that continues to grow as Bitcoin's market cap grows. Right now, the percentage of total revenue available to miners has been shrinking as a percentage of Bitcoin's market cap as time goes on. There's a chart about this in the slide. And at a certain point, I think that could either the miners themselves might all get together and say, hey, we're not really making any money doing this anymore. Yeah. We own all these data centers. We can rent them out to attackers. We can conspire to attack ourselves. We can go and buy XYZ crypto. We go buy ETH. ETH doesn't have this problem. ETH has other problems. The problems of Ethereum are sort of the nothing at stake problem and the various other criticisms that Bitcoiners lobby against it to whatever degree of validity a person assesses them to be. But one thing Ethereum doesn't have is it doesn't have a vote cost problem. You don't need to build a data center and you don't need to spend electricity to validate the Ethereum blockchain. All you need to do is own Ethereum and click a few buttons on your computer. You can criticize that a lot, but what that does accomplish in a somewhat elegant way is it means that as the price of all the world's Ethereum increases and the total market capitalization of Ethereum increases, then the percentage issuance of staking rewards that are given to Ethereum stakers for validation goes up with the total value of the protocol.
Yeah. So one question that we just kind of got to at the top there, and I want to go back to it, is like, what's the correct security budget is one phrase, but what's the correct metric for energy cost or spend that Bitcoin needs to be secure? In a world where it's a $20 trillion asset and we have like 8 bips, whatever, going to miners, like you can just be on paper and be like, that sucks. That's probably not great. Probably not going to work. At the same time, though, like right now, it's not great for miners. 2% transaction fees. The subsidy is awesome.
70 bips in subsidy is a lot of money.
Yeah, it's decent, but they know it's going to go down every year, and they're still contributing
$15 billion.
Yeah,
it's a lot.
It's a lot of money. It's contributing to hash rate growth. Hash rate growth keeps going up. At the end of the day, difficulty is what decides us, right? And like difficulty can be like the metric that we go towards. Be like, if difficulty starts decreasing, then it's a good indicator that like the market was oversaturated and we saw a drop. If difficulty keeps going up, like it has been for like ever, we'll just keep seeing investments flow into it. So the question I want to get to is like, you have a bearish prediction for Bitcoin mining long term, but like when does that hit? When do we reach that point of no return? Obviously, there's this aspect of governance with Bitcoin Core and like trying to lobby the correct people to be interested in changing things. But is it too late? Are we already down the road?
I'm actually not sure that Bitcoin governance needs to change. I think that was sort of let's just say that was considered to be a non-mutually exclusive path. And there's still a lot of technical work, whether it's through, I mean, you hosted that conference Up Next, where you hosted the brightest minds in Bitcoin development and fierce political foes who debated the merits of certain opcode changes and Bitcoin improvement proposals that were being debated amongst the community. And so there are people who are attempting to create a technical framework for scaling more Bitcoin in a completely sovereign way, where without an individual giving up their personal sovereignty over their keys and the ability to permissionlessly settle back to the Bitcoin layer 1, they can go and do a whole bunch of DeFi stuff. we can open up a huge scaling surface area and lots more transaction functionality and programmability can come to Bitcoin. That could still happen. And then that whole talk that I gave would become moot based on the current state of affairs. That's what my talk was. This is the current state of affairs. This is what the numbers look like. This is how you should think about mining CapEx and mining OpEx. And this is the current transaction fees that are being paid.
Yeah.
There are other ways that miners can participate in scaling that don't require changes to Bitcoin. For example, like right now, there is no way that miners could participate in centralized exchange trading fees generation. Like all of those Coinbase fees. I'm not trying to say, hey, we should go start Coinbase as miners. Clearly, users want to use Coinbase for whatever reason, and that's not really an on-chain sovereign experience. That's a fully custodial, regulated KYC gateway to access digital assets.
Yeah.
I was kind of pointing out this is what the market is paying for. This is where fees are being generated. I mean, Coinbase's market cap is enormous. Deribit got acquired recently. Kraken's going to IPO somewhere between 10 and 20 billion, it looks like.
Yeah.
You know, all of these companies that are generating transaction fees on top of the Bitcoin protocol, they are growing with the size of the protocol. Their stock prices are going up. Bitcoin mining is not organically experiencing that growth.
Yeah.
In the event that that trend is not arrested in some way, it could lead to some incentive misalignment.
Yeah.
There are some people building layer 2s that will effectively pivot transaction validation and sequencing from proof of work to proof of stake using Bitcoin. And that development is happening in stealth, but it's happening. And I don't think that's the worst idea, because what happens if we get to 20 years from now and there's not a healthy mining incentive, and most miners, if not all miners, are on the verge of bankruptcy? If you look at equity values for Bitcoin mining companies in Q4 of 2022, after the FTX collapse, you could have acquired a lot of hash rate for not an expensive price.
Yeah.
And then it's up to you what you want to do with that. You could continue to mine profitably. If you did that, you did great, because the price of Bitcoin recovered. And I think it was up, within 3 years, it was up 400 and something %.
Yeah.
So that was more of a price driven decline in mining economics. Whereas if it's a block reward and fees driven decline in mining economics, it looks a little bit different, I think.
Yeah. Okay. No, there's a few
Did
ideas
I answer
on a
your
pull.
question?
No, it was great. There's a few ideas on a pull on here. So I'm just like trying to think, like, how do we land the plane in terms of getting from, hey, we have a bad security budget problem, or whatever phrase you want to use, to how does translate to today with Bitcoin miners?
Yeah, I've been thinking a lot about this, and this is where I'm a little bit stuck, because what can we do to deter? Really, what you want to talk about is building in a poison pill against some kind of mining collusion that seeks to destroy the value of Bitcoin.
There's a few things like you can pull on, right? So like OpNext, we ran that conference, great. 6
How much
months
transaction
later,
fees did you make on that conference?
Very little. Like we got paid a handful tickets in Bitcoin. But we had a great conference. We're going to run it again next year. 6 months later, though, nothing's really changed. OpCat hasn't happened. CTV is kind of languishing. Maybe happens. A lot of the Bitcoin L2s, there was that hype in 2023. A lot of people threw angel checks into them, maybe wishing they had that money back. Like it just doesn't really change anything.
Mm-hmm.
And meanwhile, this conversation, which you're so brave to have, like you did it on stage at the conference, had a lot of attention, and did very well on Twitter when it was posted later. But these things seem to be like mining fee events where they're just up and then down, and then you don't see it again, right? And like the conversation moves on. So how do brave faces with bold ideas keep this conversation going? And what are you seeing maybe in the incentives that makes it happen? Some incentives I'm seeing is executive compensation is becoming more of a question recently. We're seeing people push down on that. Probably has more to do with stocks itself than in really the Bitcoin network.
I don't think that's really related to the...
It's in the mix there. There's pressure on FPPS. People are always talking about maybe that changes at some point. I've seen some recent conversations around it, but that's a pretty tired talking point. New ASICs coming out. could be a conversation there about like new ASIC providers getting in and what the future of that looks like. But yeah, anything that you're thinking of that like could be an incentive to get this conversation moving, or is it just going to be pub chats forever?
I think I'm more stuck than other people, where we've made $100 million in investments, data centers in the middle of the West Texas desert. My team has moved there. We've built relationships in this community in the energy industry. Like, we are in this business. And so it's responsible to think about what it looks like 10 years from now. At the same time, you have hundreds of millions of Bitcoiners all over the world who share the same dream. They buy into this. They believe in it. And it is an awesome thing.
Yeah.
Like to have a non-debasing, permissionless, borderless global freedom money that we can all use to restore the balance of power between the individual and the state and make money a universal human good. That's an amazing mission. That's the reason why Bitcoiners exhibit the characteristics of religious zealots. This is like a religious crusade in many ways, and I'm a part of the crusade. So I think might just be the kind of thing where you sort of better to beg for forgiveness than ask for permission. Yeah. And I don't think that the unblocking Bitcoin's political gridlock is a path that seems reasonable. You're setting yourself up to be frustrated all the time.
Yeah.
You know, my boy, Paul Sports.
The last guy you were on the show with was 18 months or so ago.
Yeah, my boy, Paul Sports. Like, he's been trying to get BIP 300 and 301 through for 6 years, and he's got the scars to prove it. Mm-hmm. And people hurl insults at him all the time, and it seems like everywhere he goes when he's on stage, he's engaged in a contentious debate. I'm not sure that going down those pathways is the right way to do it. It might be that you build some kind of staking-like protocol on top of Bitcoin, where there's a layer 2 where miners and Bitcoiners can combine the economic value of a Bitcoin holding with the electricity expenditure and data center capex from a Bitcoin mining operation, and add a layer of protection and authenticity to the investment that is being risked. Kind of like Ethereum. I mean, I hate to continue to bring up Ethereum, but the fact that Ethereum's market capitalization is connected to the rewards that are earned for validating the protocol is a fucking simple concept that makes a ton of sense. And if you can't see that, your head is up your ass. I'm sorry. Like, the fact that Bitcoin could be a $20 trillion monetary protocol with $14 billion of revenue incentive to sequence transactions and verify transactions. It's just numbers where you could be like, meh, I think I could make a little more money killing that $20 trillion protocol and disrupting that $20 trillion monetary protocol, competing with every state government and military and all the other cryptocurrencies on earth, than continuing to guess random numbers in the middle of the desert. You know, I think there's a lot of, you have to think about, miners are people that we expect to be economically rational. We expect them to do what's in their best interest. The whole fucking protocol is built on that. Yeah. That's what we've been doing. Yeah. And so it's not that crazy to imagine that when economics approach a not so bright future, when Bitcoin's rallied a lot, there's, it's hard to double when you're already worth 20 trillion. 20 trillion to 40 trillion is a big number. That at some point, the economically rational decision may pivot to be something that's a bit more nefarious, and it'd be sad. So what can we do to block that? How can we dissuade miners from doing that in a way that doesn't rely on an appeal to a state authority, an appeal to violence? Like this, we're trying to build an alternate system that stands on its own. We're not trying to appeal to a state government. Yeah. Sorry for swearing.
That was great.
I just got very passionate.
I love it. I mean, you're literally building in the desert.
Yeah.
Jamie, thanks for joining the Mining Pod again.
It's
great to see you.
Hey, I love you. Shout out to all my fans.